There has been a ton of talk when it comes to the 50-year mortgage entering the US market. And whether it enters or not, whether it's a real thing after all, it's still important to know the difference when it comes to other things other than just monthly payments when you compare loan terms like the 15, 30, and 50-year mortgage. So in the next 5 minutes, we'll cover monthly payments. What does equity look like in 5 years? How much do you pay total in interest? How much do you pay total in principal plus interest? And a couple other nuanced things that not a lot of people mention, but can definitely affect your financial health for your life and then also your retirement. Now, to make sure we're only looking at the differences caused by the loan terms, being the 15, 30, and 50 years, we're not going to include things like down payment or taxes or PMI, nothing like that. We're going to take out a 100% loan. Not realistic, but for this, it gives a really good representation of each loan and how it affects it. But we're gonna take out 100% on a $400,000 house, kind of the average in the US right now. We're going to use 6% across all loans, right? And then also, the person buying it is going to be 35 years old. We'll roll that into the end so you understand why we chose that age. And then the big thing here, so we're not comparing different cities or different states, there's going to be no appreciation. So the only equity we get is what we build by paying off the principal. So when we jump into monthly payments and starting with the 15-year mortgage, you're going to see a higher payment. It's going to be about $3,400 for the life of the loan. It makes sense. It's more condensed, so you're paying more per payment. When you move on to the 30-year loan, you do see a substantial drop, right? You're moving to $2,400. That's around $1,000 less. And this is why you start to see why these extended loans are popular, right? They're starting to fit better into monthly budgets and monthly debt to income ratios for those buyers who may not be able to afford that 15-year payoff. Now, specifically for monthly payments, the 50-year loan is obviously going to win, right? We're spreading that payment out over 50 years. And this is going to hover around $2,100 or around $300 less than that 30-year option. If you guys like simple and clean breakdowns like this, click the subscribe button. I'm going to do these weekly. Now, obviously, monthly payment is really important, right? It's what we kind of build our budgets on, but it's not the only thing that comes into play when you start looking at mortgages. We also want to look at the equity built in the first 5 years. And the only reason we do this is because a lot of people want to buy a home and then move out of their starter home in 5 years when they either have children or just need a bigger house in general. If we look at the equity built in the first 5 years for the 15-year mortgage, it's a big number. We're looking at $96,000 built in equity. And you've paid at this point a total of around $202,000. So that's about 47% of what you paid, you get back, right? In that equity, you're building that by paying off the principal. For the 30-year loan, you are going to have less. It's just the way it works. It's spread out more. You're going to end up with $28,000 over the first 5 years. It's still a good chunk of change, but you have paid in $144,000. So in reality, you're only getting 19% of what you put in back if you were to sell early and try to sell your starter home and move on. Now with the 50-year loan, we are spreading that out thin, right? So there is a lot more interest that comes into play. So over the first 5 years, you will gain about $7,000 in equity. However, you have put $126,000 worth of payments into that loan to the bank, right? So to be super clear, over 5 years, you have spent $126,000. You only own $7,000 of that house, which is only 6% of what you paid. The real trouble comes in when you sell this home. There's a couple of fees that you need to know, right? The 5% brokerage fee. Usually you pay your broker, the selling broker, 5%. They tend to split that with the buying broker. But if you just look at 5% of the house we're dealing with here, which is $400,000, that is $20,000. And that's only one of the many fees that happens to sellers. So you'd be underwater based on your equity just from that. With that being said, I think if this type of mortgage does enter the US market, it could create a bunch of stuck owners, just like the COVID era interest rates did, where nobody wants to give up their house. But instead, this time, nobody can give up their house because they can't sell it without being underwater. Now comes the big one that you've probably seen all over YouTube or TikTok or Instagram. Let's talk about the total interest you've paid over the life of each loan. For the 15-year loan, you've paid about $207,000 or 52% of the value of the home just in interest. This is just money that you pay to get the privilege to borrow money from the bank. The 30-year more than doubles. That's $463,000 you're paying just to borrow money, which ends up being over 116% of the value of the home you're buying. And finally, the big one, the 50-year mortgage will have you paying $863,000. $863,000 that doesn't even go towards the home loan. That is just paying off the bank and giving them their interest, right? That is 216% the value of the home you bought. So now let's talk about the total. What's your principal plus your interest? Everything you pay over the life of the loan. For the 15-year, it's $607,000. That's 152% of your total home value that you're paying to own that home, just because you have to pay interest back to the bank. For the 30-year, that jumps up really high, right? Overall, principal and interest is at $863,000, and that is 216% the value of the home you bought. And for the 50-year, this is where it gets crazy, right? You are paying $1.25 million for a $400,000 home. That's over 300% the value of the home that you are paying because you have to borrow over a longer time horizon. You may use that 6% at 30 or 15 or 50, but the longer it's spread out, the more the bank gets back over time. So now comes the retirement talk. The buyer that we chose is a 35-year-old buyer, which is kind of the average in the US. It's a little higher. But if that person were to take each one of these loans, there's really big things they need to think about when it comes to their retirement and financial health when they get older. The first is the 15-year mortgage. If you were 35 years old, when you took out a 15-year mortgage, you would be done at the age of 50. That would give you, if you retire at 65, a good 15 years of being able to funnel that money that you use for your mortgage into retirement saving. For the 30, we're jumping up quite a bit. We're jumping up to age 65. But the good thing is most people are retiring around age 65. So as you retire, you're removing one of your biggest bills, leaving a lot of room for spending in retirement. And here comes the crazy part, right? And not a lot of people have talked about this. If you take out a 50-year mortgage at age 35, you will be paying off that loan until you're 85, assuming you don't pay it off early. That is so deep into retirement and can cause a lot of issues. And one big thing is the average US life expectancy is only 78 years old. So most borrowers that take out a 50-year mortgage won't make it. They will not live as long as their loan. The big thing though, is that if they do live, they then have to rearrange what they do for retirement. Most retirement plans assume that most of your big expenses are going to be paid off. That being children no longer in the house. The biggest one is a mortgage or multiple cars, right? At this point, you still have one of your largest payments deep into retirement. So you're either going to have to save more, work longer, or just lower that lifestyle in retirement to a point where it may not be as enjoyable as you thought it once would be.